I first started my career many years ago, I was thrilled to design and develop products. If tech companies could launch the winking face emoji or the ability to change the color of a post to standing ovations, surely a revolutionary new critical illness product would make headlines. These days, I'm thrilled to design and develop products, but I'm a little bit less naive. So today I'm going to share a high-level overview of 4 case studies from South Africa where we see people meeting insurance where they are. Insurance remains a product that needs selling. One of my colleagues, Matt Battersby, who many of you will know, uses the analogy of sprouts. So regardless how nutritious we make those sprouts, people still prefer chocolate. And that's okay. Making people financially healthy is a worthy challenge, and to me highlights the importance of what we do. While there are many aspects to dealing with this, a key role is distribution. Rather than waiting for customers to come to us, let us go to them. We'll rendezvous where they are, and when they are there and how they want us to show up. Yes, of course, we're giving people what they want, when they want it, and where they want it. The first case study is a food retailer. My favorite place to shop, a good food retailer. Given the heavy foot traffic and wide customer base, food retailers can make attractive distribution partners. The food retailer in our first example has a target market in the lower income or socioeconomic group. Their customers highly value funeral insurance, which provides small, fixed levels of cover for the insured life and their family. The product is guaranteed issue, which means no underwriting. The fit between this product, the simplicity of the sale, and their customer base made this an attractive proposal for the retailer. The product is written via a partnership with an insurer. The retailer effectively created 2 types of products: an embedded product that's linked to shopping spend and using a loyalty program at no additional cost to the customer, and then a standard retail funeral product. The embedded product aims to improve spend at the retailer, while the retail product itself takes advantage of the convenience of purchasing this product in-store, and it's sold via a dedicated financial services kiosk. Now, the pricing basis reflects the guaranteed issue of the product, so it's higher than what you'd expect for an underwritten product, while the embedded product is cheaper due to the semi-compulsory nature of itself. Now, the secret sauce for this product is the ease of access, buying insurance while doing shopping, and the deep brand trust that the retailer has built up with the customers. For the second example, we moved to a place where my daughters love to spend time and money, and that's a clothing retailer. Similar to our first case study, this clothing retailer has a broad customer base. Their target market is in the lower to mid-income market, with customers seeking value and tending to be aspirational. The retailer in this case has set up their own license and assumed some of the risk. The retailer wanted to offer life cover with better value and higher amounts than your typical funeral products you see in the market, essentially a step up. The challenge is that guaranteed issue can be expensive, particularly as cover amounts increase. To solve this, the retailer developed a simplified issue product with only 8 questions to get cover. No bloods or medical tests are required, and the outcome is given immediately, either accepted, loaded, or declined. As noted, the inclusion of the underwriting questions brings the pricing basis down from guaranteed issue, and although the simplified approach does still cost more than a fully underwritten product, it's much cheaper than you'd otherwise get. The product is sold in-store by a salesperson, so easily accessible. And that's really the secret sauce, right? It's easy access to higher cover amounts at a relatively cheaper cost than existing products in the market, and right there where you're buying your clothes. The third case study is a company looking at online communities. While not exclusively via social media, digital marketing is a core part of their plan. This insurer targets mid to upper income people with an online cancer product. The focus on cancer enables them to create a unique community of policyholders with online information and support. The underwriting is completely digital with no testing. The simplified issue approach remains robust, so while the pricing basis is higher than a fully underwritten product, the risk management limits the additional cost. As noted, the product is sold online. Your entire customer journey is completed without leaving your home. The secret sauce here is the ease of access, the fast sales process, and that unique product offering, which is wider than just the cash payment. And that adds an additional element of attraction, along with many of the behavioral science principles that are embedded in the underwriting question set. Our last case study considers what I've called edge tech. Let me explain what that means. This is an interesting product because of how it enables being close to customers. In South Africa, there are many providers of funeral cover that fall outside the traditional insurance market, and some are informally managed. The insurer in this case study aims to help the providers themselves by cleaning up their books and bringing them into a regulated framework. The target is low to the lowest LSMs, many of whom have very little engagement with the formal insurance sector. So this is for life cover only, a funeral product for the member and their family. The pricing is high since it's guaranteed issue and given the market. However, through this insurer's intervention, the aim is to enhance the management of the book and thus reduce the pricing significantly, making the products more affordable where it's needed the most. The product is distributed through the funeral societies. The secret sauce here is the cheap and smart technology that the insurer provides, including software that they themselves have developed. Prior to them entering, many of these funeral societies don't have any good data on their policyholders or any technology behind it, often written down on paper with pen. So this changes the model completely, enabling customers to still access funeral cover where they are, but in a safe and regulated way. So as important as insurance is, it remains a product that needs to be sold. Given the friction in the market, we need to recognize shifts in behavior and, most importantly, ensure that we continue to meet customers where they are.
Despite advances in technology, improved connectivity, significant investments in insurtechs, as well as a general increase in consumer openness to transacting online, digital life insurance distribution continues to lag within financial services. Globally, direct channels, which has been slated as a key strategy to access the underserved middle market, accounted for only 6% of global life insurance sales in 2018, a number that has been flat over the preceding 6 years. Within the direct channel, which includes affinity programs, outbound calling, and traditional direct mailing, digital and mobile sales make up only a fraction. In the US, as an example, where direct is 10% of life insurance sales, less than 20% of direct channel quotes are digital or mobile. By comparison, e-commerce sales in retail has almost doubled over the same period, as demonstrated by the US retail sales stats, where online sales increased from 5 to 6% in 2013 to more than 10% in 2018. And although the pandemic has had a similar acceleration effect on digital life insurance sales, with anecdotal evidence suggesting a 40 to 50% increase on pre-pandemic levels, this is of a very low base, and digital life channels continue to make up a very small portion of new business sales. Zeroing in on the Canadian market where today's case study is focused, we see less than 3% of life insurance sales coming from direct channels. And as in the US, the bulk of this is through affinity and traditional direct marketing. Compounding the challenges to reach the broad middle market is the fact that no bank insurance distribution is allowed by law in Canada. The inability to effectively reach the middle market is evidenced by the steady decline in life insurance ownership rates, from 60% in 1981 to only 44% in 2019. In part, the sharp drop from 2006 was largely due to the global financial crisis and subsequent economic recession in Canada. And although the industry has stabilized ownership rates and the absolute number of households owning life insurance has increased since then, mainly due to steady population growth as a result of immigration policies, we are yet to fully return to historic ownership rate levels. Interestingly, the decline in life insurance ownership has mostly been among traditional market segments, as an example, married couples and parents, and has created an opportunity for industry participants to provide solutions to those with financial dependence. It is clear that the current environment provides market conditions that are favorable for recapturing some market share in traditional segments, but the traditional distribution channels have been ineffective in capitalizing on it. It is with this backdrop that RJ partnered with a digital advisor and life insurance company to unravel a mystery. Amid all the technological advances, aggressive strategies, and consumer needs, why haven't life insurance sold even more policies online? What we saw was essentially 60% of life insurance buyers starting their search online, but only a small percentage were buying the product digitally. Clearly something was missing. Something was preventing people from completing purchases online. Through our partnership, we identified 3 core areas of focus when looking to successfully reach and sell life insurance through digital channels. The first of these are education and the need for advice. People often associate the insurance purchase with a binary decision. Do I buy it or do I not? And as we all know, the choices can be much more complicated. There are many different policies and options. Each decision can have huge coverage and cost implications. Many who start their online journey get stuck when they reach the sections related to term length and coverage amount. They quickly realize that these decisions are not so simple, and this can lead the consumer to feel overwhelmed or to fear making the wrong selection. it is easier to stop the online process and go to an advisor. There has been attempts to address this and negate the need for advice by simplifying product sets. But as the next focus area points out, this has not met consumer expectations. The truth is, it's all about empowering the consumer to make an informed assessment. At the end of the day, we are still selling a promise, and when that is offered online, it can appear risky if consumers don't fully trust what's happening at the back end. By educating people, we build credibility. Until the consumer can feel confidence in his or her own decision, no one is going to pull the trigger. The customer needs time to learn. The biggest mistake we made at the start was we assumed each customer was going to pass through the process to a purchase in one go. And that is just not the case. Often, the customer journey begins with learning about the product, then talking with a partner, and finally weighing the options. The customer needs to build confidence in their decision. We encourage the customer to drop off and allow the customer to save a quote and come back. We don't force a decision, we explain options. The result has been conversion rates that are much higher than anything else in the Canadian market. 55 to 60% of those who start an application actually finish it. And that's a rare accomplishment for a fully underwritten product that requires a lot of medical disclosure in the application process. Secondly, customer expectations around product and price are critical and not set in a vacuum. One of the key factors, at least in North America, noted in why carriers have been unsuccessful in capturing the middle market in general, and through digital channels specifically, has been misaligned expectations. Product strategies has been centered around simplified or quick issue life insurance, with the idea that consumers will trade the lower cost of a traditional in-person purchasing for the speed, simplicity, and no-touch convenience of online purchases. Research has, however, shown this not to be true, and in following such a strategy, customer expectations have not been met. The reason for this is quite simple. Product feature and cost expectations within the middle market were and continue to be set by what is available through traditionally fully underwritten channels. Lastly, customer experience from end to end needs to be seamless and reflect the reality of an online buying experience. As with product and price, clients' experience expectations are not created in a vacuum. However, and in contrast to the product and price, where expectations are based on traditionally fully underwritten products, customer experience expectations when entering an online insurance sales journey are based on other digital buying experiences and not compared to a traditional insurance sales journey. Customers want a full product set and price point, but supported by a simple and seamless journey as with other online channels. It is important that this focus on client experience spans the whole buying journey and needs to extend beyond just the advice and needs creation phase. As with any sales, inertia is quick to set in and can lead to inaction. This is even more important in digital channels. We rely on the customer to remain engaged and follow the process to the end. As a result, seamless end-to-end process through both advice, application, underwriting, and placement is critical to increase conversion rates. Said differently, customers won't buy without the best of both worlds: the ease of digital purchasing journey and the comprehensiveness of a fully underwritten coverage.
We've seen what we're doing elsewhere around the world, and what we do in Australia is relatively unique. It brings challenges, opportunities, and insights that I think are interesting across the globe. Elsewhere in the world, superannuation may not be quite as well defined. Superannuation funds are organisations that run retirement savings plans. Given the history in Australia, the vast majority of these are defined contribution plans. Today, I want to talk about the 162 funds which hold 22 million accounts for 20 million Australian adults. Much like elsewhere in the world, pension funds started out as a thing only for white-collar workers and public servants. About 70 years ago in Australia, the Maritime Workers Union started pushing for broader consideration of members' lives. Specifically, they wanted employers to think about the employees not just in regards to their working lives, but what happened when they ceased work due to ill health or retirement. Then 40 years ago, about 39% of Australian workers had some form of superannuation. Inflation started spiking, And what happened then was the government and the unions agreed to offset wage increases for contributions into pension funds. And at this point, they started bringing in life insurance into that workplace insurance. In the early 1990s, the Australian government turned their minds to employees that were not covered in current superannuation agreements. And in 1993, they implemented the superannuation guarantee, meaning all Australian employers were required to contribute an amount of money for all of their employees into a superannuation fund. At this point, life insurance was recognised in the law. So the vast majority of Australians had life insurance provided to them through their superannuation funds. So for 30 years now, nearly all working Australians have had some form of life insurance. Under the legislation, this is mostly mortality cover, it is lump sum total and permanent disability cover, and it's disability income cover. The cover has grown as the funds have grown. Products provide a hugely efficient way of accessing insurance for Australians. The current insurance in group would represent a premium of about $300 for every Australian worker. And the loss ratios since 2008 have been about 90%, meaning that for every $100 of premiums received, 90 have been paid back in claims. It's an amazing way for a small country like Australia to focus on underinsurance in a very cost-effective way. However, there have been challenges. What's been interesting about this method of distribution is that in many cases it was default cover, in that members were given insurance automatically, and in insurance decisions about coverage amounts, coverage terms, and premium cross-subsidies were being made by a trustee of the super fund rather than by the individual member. So the distribution of these products was more a business-to-business sale rather than a business-to-consumer sale. This means there's always been concerns over engagement and whether the end member has understood what they actually have purchased. Further, in the way that superannuation was built up in Australia, people had multiple accounts and they lost track of their money. So it meant that they were paying for insurance that they didn't know about, that they didn't need, didn't want, and sometimes they couldn't even claim on. It became evident this was a challenge between insurance and then the inappropriate eroding of people's retirement income. So we've had to go through a lot of regulatory changes, and specifically protecting your super legislation, which ensured that insurance was cancelled unless a member positively opted in if the account had been inactive for 16 months, and then putting members' interest first legislation, which similarly required a positive opt-in approach for members with small balances and members under 25. So over the period of 2019, all super funds all of a sudden had to engage with their members on insurance in a real-time behavioural science experiment to see what was the impact of moving from default cover or an opt-out opportunity to a positive opt-in insurance would look like. And we did some research around this and to look at the outcomes that the legislation had on our members. And they were kind of what you would expect. The more ways you communicate with your customers, the more likely they are to be engaged. So we found that funds that engage with mail, email, SMS and broad marketing were more likely to have positive members opt in with them. The most effective single piece of communication was email, and that was because of the ease of the members to respond to that email. But, we would encourage everyone to engage in as many forms as possible. We also saw, much like insurance all around the world, the older age groups were more likely to be engaged in discussing insurance, and the younger age groups were disinclined. Similarly, it was professionals and white collars that were more likely to be engaged in purchasing opt-in insurance, as well as some high-risk workers, but the blue collar and the heavy blue collar were less interested in opting in an insurance. Further to this, the insurance industry has had challenges around COVID. In 2020, when COVID first hit our shores, the government made changes to allow Australians to draw down from the superannuation funds. And as to be expected, again, this was heavily accessed by our younger workers and our less wealthy Australians, putting more people into the bucket of having small balances and giving rise to challenges of underinsurance. But there's been quite a number of silver linings. The way the super funds have engaged with their customers and built trust through this time has been exceptional. We know that people trust their funds, and we know that is critical to insurance. We know that Australians turn to their super funds for insurance. and Australians are able to easily access affordable insurance with limited underwriting through their super funds. With the changes to default insurance, voluntary insurance is increasing, so more people are opting in for different types of insurance that meet their needs. So what we see as we move forward is that many funds have signed up to the Voluntary Code of Practice that calls out commitments to improve communication to members around insurance. And we know, as we've spoken about in other sessions today, that people turn to people they trust when they want to buy insurance. Clear, regular and targeted communication increases trust, thereby improving sales and improving retention. In terms of moving forward, life insurers and funds are working together in partnership on some really exciting and engaging tools. Things like calculators around insurance have been around for a while, but with the increase in digitisation, we've now got digital tools that allow you to opt in and opt out of insurance. The websites are increasing in allowing automated underwriting, and we'll see regular statements of insurance that link them through with data technology to pre-approved covers. So it's a really exciting time in the Australian industry with real engagement to the end customer, which we haven't seen for 70 years.